Well, with it, back with, unless you're living in a cave, the lending criteria, the lending map has changed over the last several years, especially with what's happened down in the States. Although there still is I guess, many different lenders that will look at multiple properties. Qualifying criteria, there is, looking at the two most popular criteria would be rental offsets. So they're looking at how much income is generated off the property versus what your property interest and taxes payments are. So you have to look at that scenario as well. Some lenders look at that. Other lenders look at adding a percentage of the rent to your income. So they'll look at it and go, okay, what is your applicant's total expenses, being maybe they have car payments, maybe they have their existing mortgage and all that, and bringing in that additional property, the rental property, or maybe two rental properties, taking, say there's $1,500 of rent coming into it, they'll take a percentage of that $1,500, add that to your income, and use that as a qualifying criteria. Those are a couple of the most common criteria that lenders use. With that, it unfortunately makes it very, very difficult for lenders for clients to qualify this way, because you start to get upside down really quick. Looking at a property that you're bringing in $1,500 in rent, a lender will only give you $750 in credit towards that. They're taking into account vacancy and things like that. So it starts to get upside down really quick. So with it, there is still a couple other lenders. There's fewer than there was a few years ago that will take a look at more investor friendly. So they look at things called DSR, stuff like that, which is your debt service ratios, where they take more into account what your whole portfolio does. What's the value of your portfolio versus market value versus rents. So they'll look at that, and also looking at almost prime lenders. When a lender makes a little bit more on that, it's surprisingly how much more they will do. So if they're able to bonus up even a quarter point, a third of a point in on the rate, that opens up a whole lot more flexibility. When you look at it with the historic rates that are so low, even if you bonus up a little bit in order for you to qualify, the whole deal may still make sense for you. So with it, maybe the rent goes from, the mortgage payment goes from $640 a month to $660. It still makes sense because the deal cash flows. You look at it going, it is kind of a cost of your business. So that's where kind of the biggest thing is.
Thank you very much, Gabe.